Up until now, we looked at the entire market always, and we studied the properties of the market solution, and we always took the market demand and market supply together. But let's look a little bit more at the determinants of one side of the market, the supply side. We will ignore the demand side for now. We will just take consumer preferences, consumer incomes to be given. So you should think that the ability and willingness of consumers to participate in the market is somehow given. And let's focus on the decisions that companies make about how much to produce, what prices to charge, and the consequences of these decisions on companies' welfare. So we will talk about the efficiency and welfare consequences on firms. In Chapter 13, we will look at the costs of production at companies. So we will focus on competitive markets. We will assume that everything on the demand side is simple and given, and we will study what happens as companies choose different output levels, how that translates into costs and revenues of the companies. From chapters 4 and 5, we should remind ourselves of the law of supply, which says that as the price in the marketplace increases, producers are willing and able to produce more units of output. On one hand, you should think that in terms of incentives, it's more valuable for producers to produce output when prices are high. So we should think that the willingness to produce is increased when prices rise. And also, because there are costs of production, and maybe these additional costs of production are higher for greater output levels, when prices in the marketplace increase, producers are also more able to produce additional units of output. Let's look at the underlying problem of companies. So we think that companies want to maximize their profits. And profits are a simple difference between total revenues that companies get from consumers and total costs of production. And in this expression, I want you to think that total revenues are a the simple part, because we're assuming that prices are constant in a competitive market, and so total revenues increase linearly in the output level produced. So you should think that every time the company produces 1 unit of output, its revenues increase by price. On the other hand, total cost of production might increase non-linearly. There might be a complicated relationship in how the amount of inputs translates into the amount of outputs produced. So additional units of output might increase total costs at a faster rate or at a slower rate than previous units of output. Okay? When we discuss this relationship, it's useful to distinguish the profits and costs that economists recognize and those that accountants or finance majors recognize. The additional complication in this profit expression is that some costs of production might not be explicit. Companies don't have to pay out cash to obtain some resources used in the production process, but that doesn't mean that those resources are not being used. So we will say that economists distinguish between explicit and implicit costs of production, and depending on whether implicit costs of production are included in the profit expression, we will say that we distinguish economic profits, which include both explicit and implicit costs of production, and accounting profits, which only account for explicit costs of production. And when we think of implicit costs of production, there are several examples that are easy to think of. In most real-world businesses, the owner of a small business, the entrepreneur, doesn't pay himself a salary and just hopes that through the production process will obtain some profits or rents, and that will be the compensation for his effort. So here we should think that when the owner of a company doesn't pay himself a salary, there is no explicit outlay of money, but there are still resources used in the production process, the managerial effort or entrepreneurial effort. So there are these implicit resources used in the production process that economists recognize that they have to be compensated. Another example is when the owner of a business uses his own house to run the business rather than rent an office building. In that case, there is no explicit payment for rent, but we should think that there are these resources implicitly used in the production process, and they should be compensated for. And so the accounting profits that the business generates should pay for both the explicit and implicit costs of production. Okay, so here is a representation of the difference between economic variables and accounting variables. One thing that we should notice in this graph is that the revenues are the same for economists as for accountants. Because revenues are simple, we assume that revenues are a simple cash obtained by companies from consumers. And the only difference between these two graphs comes from the difference in total costs of production. We would say that for an accountant, only explicit costs of production are considered. For an economist, there's an additional cost, the implicit costs of production, and we should think that the sum of the implicit and explicit costs is the total or the opportunity cost of production. So from looking at this graph, we should think that the accounting profit is always higher than economic profit, as long as there are some implicit costs of production. And we should think that accountants generally overstate the profitability of businesses as long as there are some implicit costs of production. So as I said, total revenues of producers, total revenues are a simple function linearly increasing in the output produced, and it's only the cost side which is more complicated. And to understand the cost of production at a business, we should understand the conversion between the amount of inputs into the amount of outputs produced. And one implicit assumption is that the total number of inputs used, we will multiply this amount of inputs by the wage rates or by the costs of inputs to obtain total costs of production. And and if we think that the prices of inputs are given as a simplifying assumption, we just need to know this conversion rate between the amount of inputs and the amount of outputs. So the production function gives us the relationship between the amount of inputs needed in production and the amount of outputs. We usually draw the production function this way, with inputs on the horizontal axis, outputs on the vertical axis. And if we draw different bundles that can be observed at a business, We would say that this is the production function for a company. Generally, we observe this concave shape of the production function because of, we say, diminishing marginal product of inputs used in the production process. Okay? So as a side note on this, we will keep saying that we want the production function to be eventually concave. We don't care very much whether the relationship is convex or concave for the initial units of inputs used, but for later units of inputs, we want this property. We will discuss this more in chapter 14. Okay, and an additional function that is useful to draw is the total cost curve, or total cost function, which shows the relationship between the amount of output produced and the total cost of production. Okay? Notice that when we drew production function, we drew the amount of inputs on the horizontal axis, the amount of output on the vertical axis. Now we are drawing the amount of output on the horizontal axis and total costs of production on the vertical axis. Here I want you to think that there's a direct analogy between production function and the total cost function in the production process. What we had on the vertical axis for a production function, now we have on the horizontal axis. And we used to have the amount of inputs on the horizontal axis. Now we have total costs on the vertical axis. And you should think that total costs can be written as the amount of inputs used times the wage rate, or times the price per unit of input. Right? Total costs are simply the multiplication of the amounts of inputs used and prices of inputs. So if we had a concave, strictly concave production function, here we will have a strictly convex total cost function. The additional difference is that the total cost function may not start at zero. That's because there could be fixed costs of production, which we did not show in the graph of a production function. And we can observe the same property on this graph as we observed with the production function. As we increase output, total costs will increase at a faster and faster rate. This should be intuitive. It comes from the diminishing marginal product property that we discussed on the previous graph. A little side note on diminishing marginal product. You should think that there are at least two reasons why we could observe diminishing productivity of inputs. For example, suppose that we have only one worker working at a company, and for some reason we need to hire this worker for more hours. Maybe the demand in the marketplace increased, we need to produce a greater amount of output, and so we need to hire this worker for more hours. What happens to the productivity of this worker? Well, first of all, you should think that the longer the worker has to work, the less productive he will become, because the more tired he becomes. So the greater the number of hours that we hire him for, the less output per hour he will be able to produce. The second property is that the more hours we want to hire the worker for, the less willing he would be willing to stay in the factory. The more valuable his leisure and free time would be to the worker. So you could think that for both the ability to produce and willingness to produce, we could observe diminishing marginal productivity and increasing total cost, convex total cost curve of production. We should think that if we force the worker to stay an additional hour in the factory, he will demand greater wages for the additional hours at work. And so for these two reasons, we might observe convex total cost curve. Okay. An additional thing that I could mention here is that just like we draw total cost curve, we could also draw fixed cost curve. If there are some fixed costs of production of, let's say, $3, we would say that for any output level, we would have these same fixed costs. So we could draw a perfectly horizontal fixed cost curve for the company. And now if we think that total costs are the sum of fixed and variable costs of production, we could say that variable costs of production will have the same shape as the total cost function, but they will be shifted down by the amount of the fixed costs. Right? We said that fixed costs are a horizontal line at $3. Variable cost curve would be strictly convex, $3 below the total cost curve. Okay? That becomes useful if we start discussing average fixed costs, average variable costs, and average total costs of production. We will say that there are some nice properties, some exact properties of these average costs, and some nice relationships among them. One slightly more advanced measure of costs is the marginal cost of production, which is the change in the total costs when the amount of output increases by 1 unit. And from what we said about total costs and variable costs of production, you should also think that marginal cost is the change in the variable costs of production from increasing output by 1 unit. So we could say that marginal cost is the change in total cost for a change in output by 1 unit, or also the change in variable cost of production for a change in output by 1 unit. Okay. Let's look at some more common graphs that economists draw for the production process. So from the diminishing marginal product and increasing marginal costs of production, we know that eventually marginal cost of production has to be increasing. Right? So far I said that it doesn't matter what happens for the initial units of output, we just need marginal costs to increase for greater units of output to represent the diminishing marginal productivity and the increasing costs of marginal production. So we will look at two graphs, one where the marginal cost curve is strictly increasing, and the case when marginal costs could be decreasing at first and increasing later on. As I said, we don't really care what happens for the initial units of output, so these are just the two more common forms of the marginal cost curve that economists consider. Okay, let's start with this case. So we are assuming that the company faces some fixed costs of production, and when we talk about fixed costs, you should imagine some lump sum amount of money that the company has to lay out to start the production process. So when we talk about average fixed costs, we divide this fixed lump sum amount of money by ever greater output level. So you should think that average fixed costs have to have this decreasing shape. And average variable costs, you should think that there is a nice relationship between marginal costs of production and variable costs of production. Variable costs of production just measure the additional costs of production from producing positive amounts of output. And if we start with some low per unit costs of production, here you should think that if marginal costs of production are increasing, that means that production per unit becomes more and more expensive. So if we start with some average costs of production, and we're adding higher and higher additional costs to this average, the average has to increase, right? So we would say that if marginal costs are strictly increasing, then average variable costs should also be strictly increasing at a slower rate, right? The intuition is that we have some average number. You should think of this as an algebraic property, that we have some average number and we add a larger number to this average. And the question is, what will happen to the new average? The new average has to increase. And it will not increase by as much as the additional costs increased. So we have this property that when marginal cost curve is increasing, average variable cost curve will also be increasing at a slower rate. And when we look at average total costs of production, which looks at both the average fixed costs and average variable costs of production, we would recognize that average total costs are decreasing at first and then start increasing. When the fixed costs of production are important, because average fixed cost is decreasing, average total cost will also be decreasing. But for greater output levels, when the average fixed cost becomes sufficiently small, it's the variable costs of production that become more important, and because of that, average total costs will start increasing. And so for the average total cost function, once again, we have the same intuition, that we have some average number and we increase total costs by the amount of marginal costs, right? Marginal cost is the additional cost that adds up, that is added to total costs of production. So as long as we have some high average number and we're adding smaller number to it, the average will be falling. And as soon as the additional costs of production are greater than the average will start increasing. So you should notice that the marginal cost curve crosses the average total cost curve exactly at the minimum of the average total costs. Let's look at the case when we have U-shaped marginal cost curve. In that case, we start with relatively high additional costs of production. Then these additional costs of production decrease, and finally, these additional costs of production will start increasing, corresponding to the diminishing marginal productivity of inputs. In that case, average variable costs of production are decreasing at first because we're adding smaller and smaller numbers to this average. But at some point, these additional costs of production start increasing, and as soon as these additional costs become higher than the average will also start increasing. So with U-shaped marginal cost curve, we have an additional nice property that the marginal cost curve crosses the average variable costs exactly at the minimum of average variable costs. Right? The property that we had only for average total costs on the previous slide, here we will say that we have the property for both the average variable cost and average total cost curves. Okay, so this is the situation that companies face you can think in the real world, in both the short run and the long run circumstances. As a side note, we distinguish short run and long run by the ability of firms to change the amount of inputs in the production process. We will say that short run is the situation when at least one input that the company is using is fixed. Right? Here we had some fixed costs of production even when the company was producing 0 units of output. In the long run, we will say that no inputs are fixed. The company can increase, decrease, completely sell the units of any input used in the production process. And in the long run, we will say that the production process can exhibit economies of scale, diseconomies of scale, or constant economies of scale, or constant returns to scale. Here you should think that in the short run, suppose that the company is using 2 inputs in the production process, capital and labor. Capital, let's imagine that it's a factory size used in production. Labor is the amount of workers, a number of hours workers work in the factory. In a particular short-run situation, when the factory size is fixed, suppose that the company has a small factory size and it's facing this average total cost curve in that short run. In the long run, if the company can increase the factory size, it might choose a larger factory or a larger amount of capital used in the production process and maybe use fewer workers, less labor in the production process. You can think that in the long run, the company has more ability to substitute between different inputs in the production process. So the company could choose to increase its factory size to a medium-sized factory, and in that case, company could face this average total cost curve. And finally, if the company increased its factory size to large, maybe the company could move to this average total cost curve, which is the case with maybe a large amount of capital used and maybe relatively small amount of labor used in the production process. We would say that if, as the and the underlying idea is that depending on how much the company wants to produce, it will choose the size of its factory and the amount of labor used in production. If the company is expecting to produce relatively small amount of output, it would choose to operate with a small factory size. On the other hand, if the company wanted to produce greater amount of output, it might choose larger factory size. For some particular company, we might observe these different short-run situations. At first, for small output levels, the average total cost curve may look like this. For larger output levels, the average total cost curve might be lower than the average total cost for a smaller amount of outputs. We would say that on this range of outputs, the average total costs of production fall, so we would say that that corresponds to economies of scale. For some range of output levels, the short-run average total costs might be at the same height, and we would say that that corresponds to constant returns to scale. And finally, for some output levels, as the company chooses large factory sizes, the average total cost curve might become higher and higher, and we would say that the long-run average costs of production increase, and we have diseconomies of scale. Right? So another thing to say about the difference between short-run and long-run is that in the long run, the company has more ability to adjust its inputs, so it would choose the amount of factory size and the amount of labor that minimizes the cost of production. Right? For a particular amount of output, I want you to think that the revenues that the company earns are simple. Revenues are simply quantity times price in the output market, and under the assumptions of constant prices, the company cannot do anything on the decision about revenues of the company are fairly simple. But on the cost side, the company can choose how to substitute between its capital and labor. And in this decision making, you should think that for a particular output level, the company will choose the particular short-run situation that minimizes total cost of production or minimizes the average total cost of production for that particular output level. So the company would always want to be on the lowest possible average total cost curve for any quantity that the company is considering. So we would say that the long-run average total cost curve is the lower envelope of all of the possible short-run average total cost curves. And kind of as a side note on this graph, if these three factory sizes were the only factory sizes possible, we would say that the lower envelope of these three average total costs would be a line that has three parts. Right? But if we draw this red line as the long-run average total cost curve, we're implicitly assuming that the company can choose any factory size possible. Not only this, or this, but the company could choose any short-run average total cost in between, and this red line would connect all the points on the lowest average total cost curves for any quantity. So when we draw this long-run average total cost curve, you should think that that implies continuous factory size when the company can choose from infinitely many different possible factory sizes.